is paying off your mortgage early better than investing? Because the truth is, making the wrong decision can cost you tens of thousands of pounds. So in this video, we're going to answer that very question. Should you overpay on your mortgage every month or start investing sooner? But as a bonus, we'll also discuss the 5 most important questions you need to be asking yourself when you're making this critical decision. And if you're new here, I'm a former investment analyst and accountant, and we discuss all things personal finance and economics. Now, I know what you must be thinking. I've seen a video on this topic everywhere before, and I know how this story ends. If your mortgage rate is less than your average rate of return, then you shouldn't overpay. This is a gross oversimplification and misses a whole host of factors, and frankly sells short this super important decision. Because by this logic, you would never repay your mortgage. Every time you needed to refinance, you just cash out the equity and add that to your investing strategy. But I don't see any lunatics making that case. It makes sense in a sort of half-wit kind of way. So I think the easiest way to look at this is to start by crunching the numbers. Let's say you have a £200,000 mortgage at about a 5% rate, and let's say the term is 25 years. That gives you a monthly cost of £1,170. This is going to serve as our base case. Now from here you have 2 options, either overpay £250 a month or invest £250 a month. Let's start with overpaying. If you overpaid by £250 per month, that would save you £48,820 and cut your mortgage term by a little over 7 years, which right off the bat seems like a good deal. £50 and invest it in a stocks and shares ISA, getting an average return of 8%, which is the average return of the S&P 500 after fees and inflation. Investing over the same period would get you to £1,117. £54,000 of that would be in contributions and £63,000 of that would be in interest. Now at this point, it doesn't exactly take Rain Man to work out that £117,000 invested is much more than the £48,000 you would have saved in interest. Job done. We can all go home now, right? Wrong. Very wrong. And this is where most folks would say, well, that is that, all is done, see you later. But this analysis misses one of the biggest advantages of overpaying on your mortgage, which is that once you've repaid your mortgage, that frees up cash every single month, which you can add to your investing strategy. So armed with this new information, if we rerun the numbers, what does it look like? Do we still get the same outcome? So again, let's start with our overpaying example. Same numbers, £200,000 mortgage at 5% rate, £250 a month overpayment still saves us £48,820 in interest. But after the mortgage has been paid off early, we then have the additional £1,170 per month that was going towards the cost of the mortgage to invest on top. So that means we can invest this extra amount for the remaining 7 years. So you plug those numbers in for an average return of 8% as before, and you get an investment value of £158,555. This gets us to a total of £207,000 when you combine the interest saved from the mortgage and the extra investment value. Because don't forget, a penny saved is still a penny earned. So going back to our original example, if we have £250 per month at 8%, for 25 years you get to £228,000. So whilst this more sophisticated way of doing the calculation doesn't change the overall outcome, you are still better off investing than overpaying on your mortgage. The gap is much closer than it was when we first looked at this. But before you think, well, there we are, we're done, hold on a tick, because there are other tangible factors that need to be included in your calculations. And I'm not just talking about the feel-good factor of not having a mortgage anymore. But we should also keep in mind, theoretical examples will only take us so far, and there are other things that you need to consider. So what are those things? Glad you asked. Let's get into it. So what else do you need to consider? Well, firstly, the analysis that we've done here works on averages. Now, averages can hide a multitude of sins. If I told you that in the last 15 years, average house prices in the UK have gone from £167,000 to £293,000, an increase of over 75%, and that interest rates would be near zero for the better part of over a decade, then that completely changes the maths. With property prices increasing that much and the cost to borrow money that low, the incentive to overpay was super limited. Add to that the fact that the S&P 500 has increased at an average annualized rate of 13.84% over that period, and again, another reason why overpaying just wasn't worth it. But there is a big caveat to this, which is that investment returns and future interest rates just can't be guaranteed, so don't treat them as such. If your mortgage interest rate is 5% and you decide to overpay, that is a guaranteed 5% return on your money. Put the same money into the market, and over the longer term, it is likely to go up. But past returns are not necessarily a predictor of future returns, so you could also lose money in the shorter term. Your age is also another important factor. This is a very rough rule of thumb that we generally abide by on this channel, that you should do most of your wealth building when you're under 50, and then when you're over 50 you should generally try and gradually de-risk and move towards conserving your wealth. How does this apply to overpaying on your mortgage? Well, if you're getting closer to retirement, it can make more sense to overpay on your mortgage because your investment accounts can carry on growing what you've already accumulated, just not as quickly. And using that extra cash each month once you're debt free is only going to accelerate your wealth building. Before you start setting out overpayments, worst thing would be to overpay and then get stung with an early repayment charge. You should also consider if you'll move house again. This is another important factor which I just don't see talked about enough. If you're my age and you're about to move into a house that you can see yourself in the next 10 plus years, then I think this is a better reason to want to overpay on your mortgage. There isn't much point in building equity in your home if you're going to be moving house in 2 years, because invariably all you'll end up doing is using the equity to buy a more expensive house, and as we've proven, you'd get better returns in the market. Your future income is another important variable to consider. If you're going to be made partner at a law firm and be an investment banker or an MD at your company, then this gives you more flexibility. And putting more of your money into investing earlier on can make more sense. And that's because you maybe have bought your house on a more modest salary, and then when your income ramps up, you can use that salary gain as a good chance to overpay on your mortgage. Another important point is that mortgages don't amortize evenly over the term. The first few years are almost exclusively just interest payments, so you don't even get to attacking the principal until further down the line. So if you're further into your mortgage and actually making headway in reducing the principal amount, then that can make overpaying even more worthwhile. And in some respects, when it comes to this decision, one of the most important factors that people overlook all the time is when they've actually paid off their mortgage, will they invest the extra money each month or just spend it? Because the truth is, to just look at that money and to continue to invest it takes real self-discipline. We have another video on the channel coming out very soon. Link will be just here once it's out. This is going to be about how you can use your pension to pay off your mortgage. So what should you do? I really wanted to just sit here and give you a definitive answer to this question, but I think given everything we've talked about, we can see that if I offered that, then it's just absolute nonsense, because that is just definitely not the case. There is often not a perfect decision and a perfect outcome to go along with it. There is making the best decision you can with the information you have at the time. Don't listen to people who tell you what you should do. Take the information from people who tell you what you could do. But what we can do is work on some rules to live by. Generally, when interest rates are lower, there is less value in paying off your mortgage. And that's for two main reasons. The first is that the interest cost to you is smaller. And the second is that there's an inverse relationship between market returns and interest rates. So lower interest rates are correlated with higher stock market returns. So you basically win on both fronts. You can make better gains while investing, and the amount of money you get charged in interest on your mortgage is lower. So what should you do? Whilst it is mathematically true to say that you're better off investing than overpaying on your mortgage, what's the real conclusion? What you decide to do should depend on your own financial situation and your own financial goals. These are very unique to you. So what do I do despite knowing all this? Well, I do both. I'm perfectly happy accepting the fact that I'm getting slightly lower returns because of the reduced stress of knowing that I'm gradually accelerating my way to being debt free. And we have another video coming out related to this topic, so make sure you subscribe so you don't miss it. In that video, we're going to be discussing how you can use your pension to pay off your mortgage, and that potentially can have you winning on both sides. The truth is, there is never a right answer that will serve absolutely everyone, that covers all possible outcomes, all risk profiles, all budgets, all times in their life. There's only a good answer for you, your objectives, and your circumstances. Thanks very much for watching.